All right, in this explainer, we're going to pull back the curtain on a company that, honestly, a lot of investors think they understand, but usually get wrong. We're talking about L&T Technology Services, or LTTS.
So, you look at it and you think, okay, I've seen this movie before. They've got a bunch of engineers, they work for big global clients. It feels just like another IT outsourcing shop, right? Well, that's the big misunderstanding we really need to dig into.
And here's why this matters. Getting this company wrong isn't just an academic mistake, it's a costly one. Because when you put LTTS in the wrong box, you value it with the wrong framework, and you completely miss what makes the business tick.
So let's start right there with what I call the valuation blind spot. The usual playbook that investors use for tech services companies, it just completely falls apart here. We're about to see why that whole mental model is just wrong.
First things first, we need a key definition. LTTS is in the Engineering R&D space, ER&D. Now, this isn't about coding a company's website or building a new app. No. We are talking about the hardcore engineering that goes into physical things. You know, the embedded software that runs a car's anti-lock brakes, or the complex design for a new medical scanner.
And you have to understand, these are two totally different worlds. With IT services, sure, switching vendors can be a hassle, but it's usually about saving a few bucks. It's a price-driven decision. But in ER&D, trying to swap out your engineering partner in the middle of designing a jet engine? That's a complete nightmare. The decision isn't driven by price, it is driven by risk. One is about saving money, the other is about preventing a catastrophe.
And that idea, avoiding disaster, that brings us to the core conflict here. For the clients hiring LTTS, this isn't some budget line item they're trying to squeeze. This is about making absolutely sure their products don't fail in the real world, where the stakes are incredibly high.
I mean, just look at these industries. In aerospace, you have a zero failure tolerance, period. For medical devices, you're talking about patient safety and navigating a maze of regulations. In an electric vehicle, getting the software and hardware to work together perfectly is a critical safety issue. That word there, homologization, that's just a fancy way of saying you have to get the government to legally certify that your vehicle is safe. It's a huge, non-negotiable hurdle. The point is, clients hire LTTS to make sure this stuff just works perfectly.
Because if it doesn't, well, this is what you're looking at. Your new product is delayed by a year. You fail your certifications. You have to trigger a massive recall that destroys your brand's reputation. You're talking about colossal financial damage and a PR nightmare. This is the exact disaster that big manufacturers, the OEMs, pay LTTS to help them avoid. So once you really understand that high cost of failure, you start to see how LTTS builds its competitive moat. It's not just about being a vendor. It's about becoming so deeply woven into the client's own process that they become almost impossible to replace. And you can see their strategy right here in their revenue breakdown. They're not just in one area. They're spread across a bunch of these high-stakes industries where failure is not an option. That's on purpose. They go where the cost of screwing up is the absolute highest, because that's where their value is the clearest.
So how do they create this client lock-in? It's basically a four-step process. First, they embed themselves in product development cycles that take years, not just a few months. Second, they're not just taking orders. They're co-creating, working shoulder to shoulder with the client's own engineers. Third, they often become the ones managing those critical regulatory approvals. You put all that together, and the idea of switching to someone new midstream becomes terrifyingly risky.
I think this quote just says it all, doesn't it? It's not a vendor you can just swap out. They become a critical part of the team, the people who know the product inside and out. The cost to switch isn't just about money. It could kill the entire product.
Okay, so we've got a fantastic business model built on making clients feel safe. But does that actually translate to great financials? Well, that brings us to the resolution. Let's look at the numbers, because they show the signature of a really durable business.
Before we look at a single chart, we have to start with this rule. It's a non-negotiable for any services company. If the profits you report on paper don't actually turn into cold, hard cash, then your margins are just a marketing gimmick. They're not real economics.
In this chart, right here, this is the ultimate lie detector. You see how cash flow from operations and EBITDA just hug each other year after year? That is beautiful. It's the proof that the earnings are real. It's the cleanest signal you can get of a high-quality, honest business.
And then you see this, a return on capital employed that's consistently over 30%. That is an absolutely elite number. It tells you this business is a fantastic money-making machine, super efficient at turning every dollar of capital into profit.
And that high ROCE happens for a simple reason. It's an asset-light business model with real, honest-to-goodness margins and no funny business in the accounting. The takeaway is clear. The strong business model leads directly to strong, cash-backed financial results.
But hey, no company is invincible. So we have to ask the tough question, how could this whole thing break? What are the real threats, the kill switches, that could actually sink the ship? Here are the 3 big ones you have to worry about. First, what if the cost of hiring top-notch engineers skyrockets and they can't raise their prices fast enough to keep up? That would crush their margins. Second, what if they get way too dependent on just 1 or 2 huge clients? They'd lose all their pricing power. And third, the big one, what if they have a major quality failure on a critical project? That could shatter trust and get them blacklisted for years.
And this little matrix helps put it all in perspective. That wage gap and client concentration, they're real possibilities with a high impact, so you gotta watch them. A massive quality failure? It's pretty unlikely, but man, if it happened, the impact would be extreme. These are the things that matter, not the day-to-day noise of the market.
So you weigh this really powerful, durable business model against those very real risks, and where do you land? Well, for me, the verdict is simple: boring excellence. And I mean that as a huge compliment. This is not a stock for thrill seekers.
Let's be clear, LTTS isn't cheap. The market knows it's a high-quality company, so it's priced fairly for that durability. The real edge here isn't about finding some hidden gem the market has missed. The edge comes from having the discipline to own a high-quality compounding machine and just let it work for a long, long time.
And that really brings us to the final question you have to ask yourself. In a world that's always chasing the next exciting thing, would you rather own a company that gives you that market excitement, or one that provides quiet, steady, engineering-led compounding year after year? That's the question at the very heart of this company. Thanks for joining us.